The dream is pretty seductive, isn't it? The idea that you can be the one to pick the next big thing, that one stock that just takes off and changes your life. It's a great story. But what if I told you that for almost all of us, the math behind that story is, well, it's fundamentally broken? Today, we're going to dig into the surprising reality of picking individual stocks versus just, buying the whole market. So let's just get right to it. This is the big question, right? Why is it that the vast majority of investors, and I'm talking even the super smart, highly paid professionals, just can't seem to beat the market? It's a really fascinating puzzle, and the answer, it turns out, has less to do with how smart you are and everything to do with some cold, hard math and a little bit of psychology. Okay, let's start with this number right here. 89%. Over the last 20 years, a staggering 89% of professional actively managed investment funds failed to do better than a simple S&P 500 index fund. Just think about that for a second. These are the pros, the people with teams of analysts with supercomputers, and nearly 9 out of 10 of them lost to a fund that's basically on autopilot. And this really says it all. As an individual investor, you're not just trying to outsmart those pros we just talked about. No. You're competing against high-frequency trading algorithms that make moves in microseconds. You're up against massive institutions that have a direct line to company management. Let's be real, the deck is stacked against you from the very beginning. So how does this actually happen? Well, the first part of the answer is buried in the structural advantages of indexing. These are kind of like these hidden mathematical forces that are always working in the background, and they have nothing to do with being a stock-picking genius and everything to do with simple, boring costs. And it all starts with fees. The average active fund, they're going to charge you around 0.66% a year. A typical index fund, you can find them as low as 0.03%. Now, that difference looks tiny, right? It's less than 1%. But it's a constant headwind. It means that active manager has to beat the market by that much every single year just to break even with the automated fund. And here's what that tiny little fee difference actually costs you. Over 30 years, if you invested $100,000, that small gap adds up to over $155,000 in lost returns. That's a huge pile of money going straight from your pocket into the fund managers, all for the privilege of most likely underperforming the market anyway. But wait, there's more. It's not just the management fees. Active trading creates all these other hidden costs. First, you've got high turnover. That's just constantly buying and selling stocks. All that activity racks up transaction costs. And second, every single time a winning stock is sold, guess who shows up? The tax man. You got to pay capital gains tax. This creates what's called a tax drag that just slowly eats away at your returns year after year. Index funds, they mostly just buy and hold, so they avoid almost all of this. So the structural costs, that's one big hurdle, but it's only half the battle. The other, and maybe even bigger hurdle, isn't out there in the market. It's right here, in our own heads. Our brains are just wired with these biases that make us pretty terrible at making rational investment decisions. This is where most of the real damage is done. A perfect example is something called the disposition effect. Put simply, we hate admitting we made a mistake. So what do? We sell our winners way too early to lock in a gain and feel smart, but we hold on to our losers for far too long, just hoping, praying they'll get back to what we paid for them. It is the exact opposite of what you should be doing, and studies show it costs the average investor over 3% a year. Then there's good old overconfidence. We all tend to think we're a little bit better than average, right? Well, in investing, that leads to trading way too often. This study found something fascinating. It showed that men, who tend to be more overconfident in this area, trade 45% more often than women. And what's the results? They actually hurt their own returns by almost a full percentage point every single year, just from all that extra activity. And finally, we've got recency bias. This is our brain's little quirk of thinking that whatever just happened is gonna keep happening forever. Tesla is the perfect example. After its insane run-up in 2020, tons of retail investors piled in during 2021, right before the stock took a nosedive. We're just wired to chase performance, which means we consistently end up buying high after the big move is already over. So when you combine the high fees, all those hidden costs, and our own brain working against us, you get this chart. This is the definitive scorecard, and the trend is just undeniable. Sure, about 60% of active funds might underperform in any one year, but stretch that out to 20 years, and that number climbs to nearly 90%. The longer your time horizon, the harder it is to win the stock picking game. The math just gets more and more brutal. Okay, so does all this mean that picking individual stocks is always a terrible idea? Not necessarily. This isn't a totally black and white issue. There are some very specific situations where taking an active, hands-on approach can actually be a pretty rational choice. For instance, in some of the less covered corners of the market, like small-cap stocks, a real information advantage can exist. Or maybe you're an expert in a really niche field, like biotech. You might actually spot opportunities that Wall Street misses. Plus, owning individual stocks lets you do smart tax stuff, like selling your losers to offset the taxes on your winners. And of course, it lets you build a portfolio that truly aligns with your personal values. So where does all this leave us? Well, this brings us to the practical takeaway. It's not an all-or-nothing game. The smartest approach for most people, it turns out, is probably a hybrid strategy that really gives you the best of both worlds. It's a strategy called core satellite. And the idea is really simple. You build the vast majority of your portfolio, your core, let's say 70 to 90%, with those reliable, super low-cost index funds. That's your rock-solid foundation. Then you use a much smaller slice, your satellite, to make a few concentrated bets on those individual stocks where you really believe you have a genuine edge. This way, you get the best of both worlds. You get the stability of the market, plus the potential for a little extra upside, all without gambling your entire financial future. And at the end of the day, this is really the question that matters most. It's so easy to get caught up in this idea of beating the market. But the goal of investing isn't to win some game against other people. It's to reliably and safely build enough wealth to fund your own future. So the question I want to leave you with is right here on the screen. Is your strategy built to win a game, or is it built to actually achieve your goals?